I I think the problem for the U.S. is twofold. The major problem is that increasingly when we see the Japanese yen acutely weak, it's associated with higher Japanese yields. The market is afraid that the fiscal situation in Japan is deteriorating, so the weak yen and higher Japanese yields occur together. But some of those higher Japanese yields spill over into U.S. yields. Now, the Treasury Secretary, his only job description is keeping borrowing costs down. And so when he sees this kind of risk, especially in a week like this, when they're talking about bond issuance and sort of giving the outlook for the future, he wants to be careful that he doesn't get blindsided by what's happening in Japan.
To me, there's silence here. Jesper Cole is one of the great Japanese watchers for years. Jesper Cole says there perhaps is tensions within the secondary bank system of Japan. Are there unknown unknowns we don't know about within the banking system with Japan, which makes the Secretary of Treasury want to parachute in?
That's very hard to say, especially from this distance, unless you're watching it very closely. And certainly the Japanese would be better placed to deal with their banking issues than the U.S. Treasury. I mean, U.S. is a big country, but it can't solve everybody's problems.
Okay, I want to get this in. Paul's lined up with 8 questions smarter than mine. As simple as I can, you and I read Rudiger Dornbusch. We read Rogoff. We read Opsfeld. You lived it as a PhD at Yale. Is there any likelihood this can work for Japan? I don't see an analog to the past.
I think this is a bridge, and they're hoping that something down the road happens that makes organically helps contribute to yen strength. So it could be, say, there's a deal in the Mid East, so oil prices come down. It could be that the Bank of Japan sort of raises rates so that the pressures are off. It's not a solution on its own. And we wrote a piece today, and one of the issues with Japan is that retail is exporting capital, the man on the street. And they're not going to care that the U.S. has intervened. The reasons for taking money out of Japan are very different than the reasons, say, a speculator would go short dollar yen.
How significant is it that the U.S. did join the Bank of Japan in supporting the yen here? It doesn't happen very often.
No, and it's the first time it's happened. It's the first time it happened in this form with the U.S. sort of telegraphing what it was going to do in terms of intervention. Even intervening Friday afternoon when most people are heading to the beach is like really
Oh, come on,
unusual.
You loved it. You wrote all Friday night and Saturday, right?
No, actually not, to be clear on that. I did write on Sunday. So I think there's a lot that's unusual here. And they intervened in 2011 after the earthquake. That was a special circumstance. You have to go back to 2001 and the intervention on the euro to find U.S. coming in to sort of directionally push another currency.
Do interventions work in the intermediate to long term? This one seems to be holding, but I don't know. Tell us about that.
Well, I mean, I work on a trading floor, and my intermediate and long term is longer than 72 hours.
Okay. Yep.
The answer is that if nothing changes, it's really hard to keep spending the money that it takes. So far they've been dogged. Every intervention has tried to get yen stronger so that anyone who went short yen after the previous intervention gets washed out. But there's a limit to how long you can do that. And if organically people want to take money out of Japan, at some point it goes the other way.
Robin Brooks just published this moments ago at Brookings for years with Goldman Sachs. He's been really definitive within this debate. Folks, this is really complex inside baseball. He publishes on higher yields, stronger yen. He assumes a normal place for the Japanese bond market now is price down, yield up dramatically. Is that the end outcome here? Whatever they want to do, is it there's going to be higher yields in Japan because they screwed this up so bad?
They are facing pressures. They tried very hard over the last 10 years to stimulate the economy. You had, the 3 arrows type of program, which had mixed success.
Right.
If you can't get the growth on your own,
Right.
And you're trying to use fiscal policy to do it. There's a limit to what you can do, and if the fiscal policy isn't completely successful,
right,
people look at the other side of your balance sheet and say, maybe not so good.